It all started when the company defaulted on the bond payments of 30 crores early February. These were non-convertible debentures which were due to be paid on early February, but they defaulted on that. The company was in the middle of raising the $15 million Series B fundraising round at $335 million pre-money valuation, which roughly comes to around 380 to 390 post-money valuation. And they were required to pay 30 crore NCDs at a 12% coupon rate. They were not able to pay the entire amount upfront and had to pay staggered amounts, some upfront and some later. But because of that, because these payments were delayed, the company was in a very bad shape, and the bond owners had to kind of trigger a lot of legal action against the company. Today we are talking about Blusmart, which was once a darling of angel investors, angel networks, VC funds, and customers alike. If you look at all the reviews which Blusmart got over the years, it was absolutely mind-blowing. But today, they are in an absolutely tough spot, despite their GMV of 675 crores this year. Blusmart is essentially a story of a capital-intensive, loss-making business with an average car fleet and questionable corporate governance, which makes it extremely difficult for the company to be able to either exit out through M&A option or find new investors for further investment. On top of that, the top executives, which comprised of CEO Anirudh Arun, CBO Tushar Garg, and CTO Rishabh Sood, have exited the company as well. They have handed in their resignations and are currently serving notice period. In such a situation where the fundraising is compromised, the company is unable to pay in their debt, top executives, the top C-suite executives are leaving the company. In fact, according to reports, even their VP of Experience Priya Chakravarti and VP of Business Development Avi Katyan are also in the talks of exiting. So today we'll talk about this journey of once a darling of VC investors and even the customers who were tired of Uber-Ola duopoly and the declining service of Uber and Ola, and are extremely supportive of Blusmart, is now kind of facing such a tough challenge. The company presently is undergoing a major restructuring exercise with Gensol Engineering, which is a part of the portfolio of two of the Blusmart co-founders, Anmol and Puneet Jaggi. So let's kind of talk about the entire journey of how Blusmart has evolved, how the Blusmart came about in 2020, and how they grew over the years from 2020 to 2025, and what brought them to the situation. In 2020, as I mentioned, it was a darling of investors and raised a lot of capital at very high valuation, primarily because of the backing of Gensol, which was the main leasing partner for the company. And they raised at a capital at a significantly higher valuation than what the revenues would justify. Because of that, they were able to offer top-notch customer service to their customers, earn raving customer reviews and feedback across all social media platforms, whether it was Twitter, Facebook, Instagram, LinkedIn. Everyone was raving about the phenomenal performance and the phenomenal experience which Blusmart would have. Gensol Engineering is essentially the backend, which is the spine of Blusmart, just supporting the entire company. Currently, the company's monthly revenue run rate is around 70 CR with an annual targeted GMV of 675 CR. There were some reports that Blusmart was currently also in talks with Uber for acquisition to build their Uber Green service, but Blusmart has categorically denied that. They have categorically denied any talks of acquisition and are in talks for doing financial restructuring. There has been no update from Uber about this yet, which kind of makes it even more in a bad situation for the company. While the company is denying the fact that they are in talks of merger and acquisition, there is no denying the fact that the company is in serious trouble and they need to do some deep internal thinking and do some financial restructuring to ensure that the company is back in its place. So what essentially went wrong? In an asset-heavy business like this, Gensol Engineering was primarily the one who was backing the company and made Blusmart what it is today in terms of helping them reach a level where it could raise such a huge amount of funding. Let's talk about right from the beginning stages and what happened in the subsequent stages. Gensol, as I mentioned, was the key player in ensuring that the Blusmart grew as quickly as it did and was able to offer such amazing returns. This was a classic case of collaboration between two players in the same industry, and something which every founder would die for, right? If you have a strategic collaboration with another electric player, that would be something which would really help your company grow. Gensol helped Blusmart fleet acquisition by offering low-priced car leases on Tata Express lease to Blusmart. Gensol had leased 5,000 cars to Blusmart out of the total fleet of 8,000 cars of Blusmart. So over 50% of the cars were leased by Gensol to Blusmart at discounted prices to ensure that Blusmart grows rapidly, and they were able to raise a lot of funds as well. While this strategic collaboration between Gensol and Blusmart, it raises a lot of corporate governance flags because you have the same co-founder of both companies. It also offered a lot of benefits to Gensol as well, where the share price went from 59 rupees in December 2021 all the way to rupees 23.92 in October 23. As I mentioned, if you have the same promoters, the same directors in two companies which are collaborating like this could create a potential conflict of interest without an independent management in place. So that is what kind of triggered the entire situation. The payment delays from Blusmart to Gensol towards the 5,000 cars which were leased by Gensol to Blusmart, which has tremendously high financing costs. On top of that, Blusmart was suffering from poor unit economics because the cost of servicing and offering the cab service to customers was extremely expensive, and they were offering on very low, around 10 to 20% margins, which was not enough to sustain the operations. Gensol profitability got affected due to Blusmart payment delays and over excessive dependence on one client. Essentially, when after a point, Blusmart became the sole client for Gensol, and they were entirely submitting all their vehicles just to Blusmart. So over dependence on one client put Gensol in a very tricky situation. And now in 2025, this has turned into a complete disaster. With the delay in payments from Blusmart in February, as well as the delay by Blusmart to pay Gensol for the leased cars, the credit agencies have downgraded Gensol to default or junk rating, and the share price is down by 71%. In fact, Gensol's independent director, Mr. Rajesh Jain, also resigned about 3-4 weeks back and is not confident about the future prospects of the company, primarily because the company is growing way too fast. Not just Blusmart, Gensol is growing way too fast without having the financial backing in place, without having proper financial controls in place to ensure that the risk is taken care of and not just the obsession with growth. In fact, during his exit, he had suggested the company needs someone who can put the finances back in place, put some controls back in place. In fact, some sources also say that Blusmart is planning to wind up their Dubai operations due to a cash crunch and potentially sell it to the largest cab aggregator in Dubai, which is Careem. While the company is still denying this, there are increasing reports about this, but the truth is yet to be known, and we'll only get to know in the near future. As of March 2025, company has an outstanding net debt of 208 crores out of a total debt of 980 crores, which for a company with 675 CR GMV is way too high. Because as I mentioned, 675 CR is not the revenue, but the GMV. The actual revenue is probably close to around 10 to 20% gross margins, and with such low gross margins and having such high debt, it's going to be next to impossible to fulfill that. So what are the options which are left with the company? First option would be financial restructuring, where Gensol sell their existing car leases, the 5,000 car leases which they've given to Blusmart, they sell it to someone else and recover some of the monies back. So Gensol is back in track and operating as an independent entity. Now the question is, which buyer would buy such leases, and would Blusmart be able to service the lease to the new company? So again, while this might save Gensol, it will still put tremendous strain on Blusmart, because the company who's buying the lease, they would probably want more returns than the one that they're paying for from Gensol. So having this sorted is going to be extremely important. Another alternative approach would be complete M&A to another cab service company or a transport company, since cab aggregators won't be a direct fit here. Cab aggregators prefer an asset-light model where they don't have to purchase the cars, but the other players purchase the car. So if Ola, Uber, Rapido, they were to come in, they would probably ask one of their car lenders to purchase the assets from Gensol and operate it within their own inventory, but the chances of that happening are very low. And in fact, the co-founders, Mr. Anmol Jaggi, has also said that they are not looking for M&A and they will still hope to retain the control of Blusmart. So the important learnings from the entire Blusmart chapter is that raising capital is absolutely important, but there must be sanctity on the amount of capital and the valuations. Most companies which have raised at exceedingly large valuations have seen a serious markdown in the last few years. You look at Paytm, Ola, Oyo, Blusmart now. In fact, most large companies which have raised tremendous amount of funding, they've all seen serious markdowns. The most notable example being Byju's. In fact, the founder in many cases may be removed from the operations of the company as well. We saw that happening already with Blusmart and with Byju's, which is one of the biggest, most notorious case in India's startup history. So that is why it's extremely important to retain sanity when you are trying to raise funding and the valuations. High valuations is not a replacement. Doesn't mean that the company is going to be successful. What's really going to make the company successful is real revenues, not just high valuations. At the same time, you also need to look at debt. While debt is extremely important in raising money for your business, to raise finance for your business, debt alone is not sufficient, because debt by itself, you need to repay that. And if you lose tremendous amount of debt with hundreds of crores of debt on your board and you don't have enough revenues to kind of make up for it, the company will be in serious financial trouble. Hence, it's extremely important to ensure that you take debt with sanity. And the third point is that whenever you're selling your service, you need to always be gross margin positive. What I mean by gross margins, that the cost of selling the offering always needs to be higher than the entire variable expenses of the company. Because only then is there a possibility that you can increase the sale to a certain level where you are actually increasing the revenues, you're actually increasing the gross margins to the point that the pendulum eventually shifts and you become from a loss-making company to a profit-making company. If you're selling it lower than the variable cost of the company, that is a complete recipe for disaster, because essentially you're losing money every time you're selling your product. It's a very wrong way to sell your product and a very wrong way to build a business. Current quick commerce players are essentially operating that way, where they are primarily making tremendous losses in the variable expenses, right? And they will face this challenge when the VC funding or the PE funding stops at a certain point. Hence, it's absolutely important that you ensure that your gross margins are always positive. Ideally, minimum of 10-20%. A good business would have it like 40 to 50%, because by the other fixed expenses which come up, depreciation and other things come up, eventually the net profit will come down to 10-15%. For that, you need to have at least 50% gross margins. But when you're starting out in your early stages, it's absolutely important you need to have at least 10 to 20% on top of your variable expenses. Only then your business can go in the long run. So I hope you found this business session valuable. Like this video, share this video to your friend.